Whenever we try to gauge the actual health of the economy, we usually end up staring at these massive macro indicators.
Right. The big national numbers.
Yeah, exactly.
Yeah.
We look at federal interest rate charts or, national unemployment figures, broad consumer sentiment indexes, but those macro numbers often feel totally disconnected from what is actually happening on the ground.
Because they're lagging indicators. I mean, by the time they tell you there's a problem, the damage is usually already done.
Right. They give you the weather report for the entire continent, but they don't tell you if it's raining in your specific neighborhood.
Exactly. If you really want to know what the economy is doing in real time, you don't look at the macro data, you have to look at the micro plumbing.
Which brings us to our mission for this deep dive. Today, we are looking at a set of sources that serve as a direct window into that financial plumbing. We're looking at Associated Banc-Corp's Q1 2026 earnings presentation and their press release, which is dated April 23, 2026.
And for those of you tracking the regional banking sector, ASB is just a fascinating case study right now.
It really is. We are going to look under the hood of these documents to decode how a regional bank actually makes money, how they manage risk, and how they expand in a really complex economy.
And this isn't just about one bank's balance sheet, right? Understanding ASB's quarterly performance is essentially like taking the economic blood pressure of the Midwest.
Okay, I like that analogy.
Yeah, because their loan and deposit data, it reflects raw human behavior. It tells us whether mid-sized businesses are actually growing, if consumers are saving, and how money is genuinely moving in the real world.
Okay, let's unpack this, because the headline numbers from this Q1 report, they're telling a very specific story about momentum.
What's fascinating here is that ASB just posted a very solid quarter. They reported $117 million in net income.
Wow.
Yeah, $117 million, which translates to an earnings per share of 70 cents. And context is absolutely critical here. They are coming off their strongest bottom line in company history back in 2025.
Right, so they aren't just flashing in the pan.
Exactly. Sustaining that level of profitability requires serious execution, not just, favorable market wins.
Well, and sustaining it requires a highly functional core engine. To understand how they get to that $117 million profit, we first have to look at the fundamental mechanics of the bank.
You can't understand the destination without looking at the engine.
Right. So in banking, the fundamental engine operates a bit like like a financial respiratory system. The bank breathes in deposits from the community, and it breathes that capital back out into the market in the form of loans.
A respiratory system is actually an apt way to visualize it. So if we look at the inhale side of the equation, total period-end deposits for Q1 sit at $35.7 billion.
$35.7 billion.
Yeah, which is a 1% bump from the previous quarter. But the metric that really dictates the health of this system is their core customer deposits. And those sit at an incredibly strong $30.4 billion.
We are definitely going to dig into the structural advantage of those core deposits in a minute. But the exhale, the deployment of that capital is where the strategy gets really visible.
For sure. Total period-end loans grew to $31.8 billion.
Which is what, a 5% increase year over year?
Exactly, 5% up. But you don't really see the aggressive posture of the bank until you isolate their commercial and industrial or C&I loans.
The C&I portfolio is the undeniable standout here. I mean, they hit $12.3 billion in C&I, which is a massive 13% jump from Q1 of 2025.
It's a huge leap.
It is. And that 13% jump is the leading indicator I want to focus on, because when people think about bank lending, the default image is usually, residential mortgages or credit cards.
Right, or maybe financing a massive real estate development.
Yeah. But a C&I loan is an entirely different animal. Why is everyone so obsessed with C&I loans specifically? Why not just stick to mortgages?
Because C&I loans are the actual lifeblood of business expansion. Unlike a commercial real estate loan, which is it's largely passive capital sitting in a physical brick-and-mortar structure.
Like an empty office building.
Right, exactly.
Okay.
But C&I is active working capital. It's a regional manufacturing plant financing a new fleet of automated forklifts.
Oh, right.
Or it's a wholesale distributor upgrading their entire logistics software ecosystem. Or maybe a Midwestern utility company actively expanding its grid.
So it's pure capital expenditure. It's the literal gears of the supply chain turning.
Exactly. And that tells us something profound about market psychology. A 13% year-over-year growth in C&I means local business operators are actively investing in their own growth.
They aren't hoarding cash defensively.
Right. Taking on debt right now requires a high degree of economic confidence. These business owners are betting that the return on their new equipment will comfortably exceed their cost of borrowing.
So the engine is breathing heavily because the local economy is actively sprinting. But, I mean, there is a mechanical limit to that, right? ASB has a 165-year legacy rooted in Wisconsin.
Yeah, it's a long time in one market.
Right. And no matter how deep your ties are, you eventually hit a ceiling. You simply run out of local factories and distributors to finance.
Which naturally leads to how they're finding new borrowers to fuel this engine. To maintain a 13% growth trajectory, you are forced to look outside your historical backyard.
And the sources outline a highly calculated push into new hunting grounds. We are looking at major strategic metro markets with entirely different demographic profiles, specifically Dallas-Fort Worth, Kansas City, and St. Louis.
And they aren't just opening up random retail branches in these cities. They are deploying highly specialized verticals, like they've aggressively expanded their Kansas City C&I team, and they're hiring private banking directors specifically for these new markets.
But the initiative that really caught my eye was the launch of their new franchise banking vertical.
Oh, the franchise banking vertical is such a brilliant play for a bank looking to scale quickly.
How so?
Well, think about franchise ecosystems, whether it's quick service restaurants, fitness centers, or automotive shops. They require consistent, predictable financing.
Right, because a gym in Dallas looks pretty much exactly like a gym in St. Louis.
Exactly. Once a bank understands the underlying unit economics of a specific franchise brand, they can rapidly deploy capital to multi-unit operators. It's a repeatable model that generates excellent cash flow.
Okay, so that organic growth strategy makes sense on paper, but then we look at the inorganic side of their expansion playbook.
The ANC deal.
Yeah. The sources highlight the official closing of the American National Corporation, or ANC, acquisition on April 1st, 2026. The materials note that over 40 ASB leaders were recently physically on the ground in Omaha to map out the integration.
It's a massive undertaking.
It is, and here's where it gets really interesting, and honestly where I have to push back a bit. Expanding into places like Dallas and acquiring whole companies like ANC, right now it feels like stepping on the gas while driving in the fog.
How do you mean?
Well, isn't aggressive expansion during unpredictable economic times a massive risk? M&A in banking is culturally messy. Integration costs always overrun projections, and banks often just end up overpaying.
That is the exact pushback institutional investors bring to the table. But the data here suggests this is about mitigating risk, not compounding it.
Okay, explain that.
It comes down to geographic concentration risk. If your entire loan book is tied to a single state's economy, and that state experiences a localized downturn, say, in its primary industry, your balance sheet is entirely exposed.
So it's not reckless speed, it's calculated diversification.
Exactly. By entering diverse markets like Texas and Missouri, they reduce their reliance on a single geographic region. They're diluting their legacy concentration risk.
That makes sense.
And the numbers back it up. The ANC acquisition is expected to accelerate their total loan and deposit growth by 17 to 19% in 2026. For a regional bank, a 19% acceleration fundamentally alters their competitive positioning.
Okay, so the growth thesis relies on bolting on this massive new engine via ANC, but expanding into new markets is expensive. This forces us to look at the high-wire act here.
The margin.
Right. How are they managing their profit margins while interest rates are fluctuating and they're funding all this expansion?
Well, they have to look at their net interest margin, or NIM. It dictates the actual profitability of the spread between their liability costs and their asset yields.
And in Q1 2026, ASB managed to hold their net interest margin at 3.03%.
Which is really solid.
It is. But the underlying mechanics of how they maintain that spread are fascinating. In Q1, the yield on their total earning asset, basically the interest they collect from their loans, actually dropped by 14 basis points.
So their top-line revenue rate contracted slightly.
Right, the yield went down. But simultaneously, their interest-bearing liability costs what they pay out to fund those loans dropped by 15 basis points.
They managed to lower their own costs faster than their revenues dropped.
Exactly. It's like a retail store selling a product for slightly less, but somehow negotiating an even bigger discount from their suppliers so they actually make more profit. How does a bank mechanically execute that in a single quarter?
It requires surgical precision. They actively manipulated the composition of their funding base. Let's go back to that $30.4 billion in core customer deposits we talked about earlier.
Right, the healthy part of the inhale.
Exactly. Core deposits, your everyday checking accounts, payroll accounts, they are incredibly sticky. Customers rarely move their primary accounts just to chase a tiny fraction of a percent in yield.
So they're a cheap, stable fuel source.
Highly stable, low-cost fuel. Now, the opposite of that would be wholesale funding. Things like brokered CDs, which is institutional money. It's highly transient and strictly yield chasing.
It's expensive fuel.
The most expensive fuel a bank can use. What ASB did was proactively reduce their reliance on that expensive wholesale funding by 4%.
Which the sources say was about $401 million?
Yes, $401 million in high-cost institutional money that they intentionally shed from the balance sheet
Yeah.
because they had the operational liquidity to replace it with the seasonal inflows of those much cheaper core deposits.
Wow. So swapping out $401 million of premium-priced funding for low-cost core deposits is the direct mechanism that drove their liability costs down.
You see it directly in the data. Maintaining a NIM over 3% in a fluid rate environment doesn't happen by accident. It is the result of deliberate, proactive asset liability management.
That deliberate management provides a perfect transition into the final piece of our analysis. We've seen the growth, the acquisitions, the margin management. But in banking, rapid growth can sometimes act as a smokescreen.
A bank can generate massive top-line growth just by lowering its underwriting standards and taking on bad credit.
Exactly. Rapid growth can mask bad decisions. So to get the full picture, we have to flip the rock over and look for cracks in the foundation. We need to examine their risk profile.
Because when the economic cycle turns, poorly underwritten loans immediately reveal themselves.
Right. And the sources provide a very clear picture of their credit quality, particularly regarding the commercial real estate portfolio, or CRE. Total CRE sits at $7.4 billion.
But the metrics that track actual distress are remarkably low.
Yeah, their net charge-offs, basically the loans they've just given up on collecting, are incredibly low at just 0.07% annualized.
7 basis points. That is an incredibly clean loan book.
Furthermore, their non-accrual loans where the borrower is still around but has stopped making payments, are only 0.35% of total loans.
And they're well provisioned against any future issues. Their allowance for credit losses on loans, the ACLL, sits at a very healthy $425 million.
Which is 1.34% of total loans. And their capital position is strong, too. Their CET1 capital ratio is at 10.47%, which is well within their target range.
The raw data really paints a picture of a fortress of balance sheet. The provisions are robust, and the actual realized losses are functionally negligible.
Okay, those metrics are strong, but here's where I really need you to square the data with the broader market panic. Every time I read the news, people are terrified of commercial real estate.
Ah, the doom loop narrative.
Yes. Specifically, the empty downtown office building apocalypse. Remote work has hollowed out these massive central business district high-rises, and everyone assumes regional banks are just holding the bag. Just how exposed is Associated Banc-Corp to the empty office apocalypse?
If we connect this to the bigger picture, the data completely dismantles that fear regarding ASB. You mentioned their total CRE portfolio is $7.4 billion.
Right.
But office CRE, the specific asset class driving all this anxiety, represents a tiny 2.35% of their total loan portfolio.
Wait, really?
Yeah.
Just 2.35%.
Yes, it's essentially a rounding error in the context of a $31.8 billion total loan book. It is highly manageable.
That's a huge relief.
But the composition of that 2.35% is even more revealing. Roughly 81% of those office loans are suburban, not central business district high-rises.
Break down why that distinction matters so much. Why is a suburban office park fundamentally safer than a 40-story downtown tower?
They possess entirely different tenant profiles. A massive downtown high-rise often relies on a few anchor tenants, like large tech firms or multinational corporations.
Who are highly susceptible to remote work trends.
Exactly. If an anchor tenant drops 100,000 square feet of space, the building's cash flow collapses. But suburban office parks are highly fragmented.
What kind of tenants are in the suburban ones?
Local service providers, dental practices, regional law firms, wealth management boutiques, medical specialists. These businesses require physical space to operate.
Right, you can't really do dentistry over Zoom.
No, you can't. And their employees often live in the immediate suburban radius, and they tend to sign long-term, sticky leases. The cash flows are highly diversified and deeply integrated into the local community.
So their risk is highly granular and intentionally insulated. ASB's office exposure isn't just mathematically small, it's structurally shielded from the macro panic.
Precisely.
So, tying all of these threads together for you listening, we began this deep dive with the goal of using ASB's quarterly earnings to look at the financial plumbing. And what emerges from the data isn't just a spreadsheet.
No, it's a highly coordinated strategy.
Exactly. Bringing in core deposits, deploying them into commercial and industrial growth, expanding geographically via ANC, and tightly managing their real estate risk and their margins.
It is a phenomenal demonstration of agility. And honestly, analyzing their Q1 performance through this lens leaves me with a final kind of lingering thought.
What's that?
Well, for the last few years, the narrative has been that massive, too big to fail banks will eventually swallow up everything. That regional banks are a dying breed lacking the scale to compete.
Yeah, that's definitely the Wall Street consensus.
But looking at how Associated Banc-Corp has dynamically expanded its footprint, managed its margins, and insulated its risk, it begs a really fundamental question.
Which is?
Are we vastly underestimating the survival skills and the agility of the regional bank in the modern economy? Could it be that being close to the ground, intimately understanding the cash flow of a suburban medical park or a local franchise is actually a superior evolutionary advantage to simply being too big to fail?
Because massive scale often breeds operational blindness.
Exactly. Maybe the behemoth banks are just too far removed from the actual financial respiratory system of the local economy to allocate capital efficiently.
That is a fascinating paradigm to mull over, especially the next time you see a macro headline predicting the demise of the regional banking sector.
It really puts the data in a new light.
It does. Thank you for joining us on this exploration of the sources. We hope pulling apart the nuts and bolts of this earnings report gave you a sharper lens for viewing the economy. Remember, keep questioning the numbers behind the headlines and keep looking at the plumbing.